Okay, Professor, are you ready?
When did you arrive? Was it
Okay, you ready? No. Okay. Assalamu alaikum wa rahmatullahi wa barakatuh. Good afternoon, everyone. We're about to start the plenary session 2. Welcome back after lunch. We're going to try and maintain the time and the pattern that was established in the first session, which was so well run by Volker Nienhaus. In this session, the subject is mutual, solidarity concepts and business models. We have two papers, one by Professor Mahmoud El-Gamal, who needs no introduction as a very distinguished economist, statistician, and many other things as well. Very distinguished career. And we also have from India, Dr. Shariq Nisar, who is sitting to my right, who is an economist and one of the leading practitioners and teachers of Islamic finance in India. So without further ado, let me ask Professor Mahmoud El-Gamal to present his paper, Reciprocity and Justice within the Context of a Unified Theory of Riba and Gharar.
Yes, one sec. I think you'll be answered. Okay.
Thank you very much, Mr. Chairman.
And just to remind you, Professor, I will give you 15 minutes and give you a 5-minute and a 2-minute warning.
Okay, oh, perfect. Then I don't need to watch the time. Mutuality is a topic that's very close to my heart, but my purpose... Okay. My purpose in this talk is to warn that turning it into another holy cow, thinking that the mechanics of mutuality can solve the problems that Islamic jurisprudence has a purpose of solving, leads to the same problem that we have with other mechanics of Islamic finance. So to start with how I think about Islamic jurisprudence, my understanding is based on the analysis of Ibn Rushd that the objective is ultimately justice, equity, and exchange, which in the case of exchange also ensures efficiency because when goods and services are priced correctly, it leads to efficient allocations of resources in the economy. So Ibn Rushd says that there are basically 4 prohibitions. Either the object of exchange is itself forbidden, or there is riba, or there's gharar, or you can show that the transaction leads to either riba or gharar. And this is basically because Ibn Rushd himself was Maliki, of course, is the rule of Sadd al-Tara'i', that if you know that a particular stratagem or mechanism will lead to riba, then it's just as much riba. And so from this, I conclude that Islamic finance is legal arbitrage, taking a transaction that you deem to be riba, taking it apart, putting it back together, cannot possibly be a solution because at best it leads to the same outcome. And therefore, if the original outcome was riba, then this is also riba. So with all due respect to the chicken metaphor we had this morning, I think that is condescending to Islamic scholarship. The bulk of Islamic finances that exists today basically takes a loan and tries to replicate it another way by adding degrees of separation. So instead of having money for money, money now for money later, you have some commodity that goes in between, and then between the debtor and creditor, you can also add a third party, which could be a fictional special purpose vehicle. In reality, if we look at a financial institution that says does murabaha finance, which of course the original murabaha had no time component, therefore there was no finance in it, but let's even take the credit sale with a markup price, which is permitted by the vast majority of jurists. A financial intermediary is really not in the business of selling cars, you know, on installments or selling houses on installments. It's in the business of financial intermediation. So if we take the term murabaha seriously, murabaha is a trust sale where the seller is supposed to reveal their cost and then you negotiate over the markup. The cost here is the cost of funds. The markup is the net interest income, which allows the financial intermediary to make a profit. And therefore, what should be revealed is the markup on the interest rate that's the source of funds, no matter how you structure it. That would be true murabaha in finance. But of course, that's not what is done. Is there a way I can hide this? I just click on this? No. I want to hide the bottom thing so the whole slide can show. It's okay. If it takes so long, okay, I'll just go on.
We'll give him an extra 1 minute to speak.
Okay, thank you. So what the bottom bullet says that's a little bit truncated is there's actually a very old analysis. So Ibn Qayyim in A'lam al-Muwaqqi'in goes through some of the arguments that his teacher Ibn Taymiyyah gave for why he forbade things like tawarruq. He said all you're doing is replicating the same riba, just making it cost more. And then he says that riba in the ground would be less harmful than riba atop a tall ladder. And all you've done is just add more trade that added cost, but in reality, it couldn't remove any of the harms that were intended by the legislator, and therefore it's just worse than the original riba. In the area of mutuality, what has existed mostly is Takaful, which uses the rhetoric of mutuality in insurance and uses a legal trick, essentially, that in non-commutative contracts, contracts that are not exchanged like sale and so on, the rules of Riba and Gharar are suspended. So for instance, Imam al-Qarafi, another Maliki, Egyptian legal theorist and jurist, says, look, an interest-free loan is still Riba, because the hadith says hand-to-hand and an equal amount. So interest-free is equal amount, but not hand-to-hand, therefore it's still riba, but it's exempted from the rules of riba because it's non-commutative because of its charitable component. The same would be true for takaful as an insurance. You're not buying insurance from a company. It's a group of people who come together, put money into a pool to basically diversify the risk among themselves. And we heard people talk about risk sharing before, although I'll be questioning some of their thinking as well. What we have in reality is pseudo-takaful, and we heard some of the arguments this morning about why takaful itself doesn't scale easily, because the only way to bring in more capital, to bring in more shareholders, is to bring in new policyholders. And so what you actually do is you create companies with shareholders who are trying to maximize profits that then has to find the legal stratagem in order to provide the insurance to the policyholders in the form of either voluntary contribution or a number of other methods, but we have very large mutual insurance companies here in the US. So I think scalability in insurance has proven not to be as big a problem. It's a bigger problem in credit, and maybe I'll get a chance to discuss that in the Q&A if there's an opportunity. But what I wanted to get to is the issue of injustice. Ultimately, the objective is to minimize or eliminate injustice in transactions. We already know in commutative contracts, in sales, leases, and so on, you can exploit somebody, right? If somebody came to a loan shark and said, I'm willing to borrow at 100% overnight because I'm desperate for money, and the loan shark said, well, I can't lend you the $100 to feed your kids, but what I'm going to do is sell you this remote that's worth $100, and you have to pay me $200 tomorrow. Oh, and by the way, my neighbor will buy it from you for $100. This is an ancient trick that had existed in all societies in order to circumvent the rules of riba. It does not eliminate injustice just because we're doing sales. It does not eliminate injustice just because we're doing leases. Justice or injustice is determined by the price of credit that's being provided. So there is this, just to try to chop down other holy cows. I mean, we keep hearing that somehow the Islamic ideal is partnership finance. And I really don't know where this idea came from, because there's absolutely no basis for it in Islamic scholarship. If you take mudaraba, for instance, that is presented as the Islamic ideal that we hope more people would use, there isn't a single verse in the Quran that supports it. The only two hadith that are available are weak. And there's nothing really from the tradition. There are things in seerah that don't rise to the level of valid hadith. that support it. So, as a matter of fact, scholars over the centuries debated how to justify mudaraba because it sounds a lot like what they called ijara bil-gharar. It sounds like you're hiring somebody, the Rabb al-Mal, the capitalist is hiring the worker, but the wage is uncertain. So if you look at it from the point of view of commutative contracts like hire contracts, leases, it includes excessive gharar. Why don't you just specify the wage that you're going to pay the person? Why do you give him a share in the profit, which is uncertain? It was eventually justified based on preponderance, but it really has no foundation in Islamic jurisprudence, whereas that exists in numerous ahadith, including the Prophet ﷺ himself taking on credit. So the reason I'm bringing this up is to show that riba and gharar are really one and the same thing, or at most two sides of the same coin. You read in some of the traditional scholarship, and even some economists unfortunately say, well, the problem with interest is its return without risk. Anybody who's taken even an introductory course understands credit risk. It's just a different type of risk. It's difficult to quantify risk because in good times, you tend to underprice credit risk. That's really what precipitated the crisis. It wasn't credit itself. It was the fact that credit risk was underpriced because everybody assumed that the collaterals, the underlying assets that were financed, would keep appreciating forever. So, so can you exploit somebody with mudaraba? Of course you can, right? You want to hire somebody and you know that the wage is roughly $100 for this job. And you know that the profit you'll make out of it is somewhere in the neighborhood of say, $200. So what you should offer him is 50% of the profits in order on average to make the same. But there's nothing in partnership to stop you from specifying any profit sharing rule. So you can say, I'll give you 20% of the profit, and there's one-sided incomplete information that's excessive. This is very excessive gharar in this mudaraba. It's far from optimal. It's far from fair. It is pure exploitation, except you made it to mudaraba. You say, but if I make it to musharaka, it will be different because losses have to be proportional to capital. Well, that's trivial to arbitrage. All you do is give the person 1 cent as a gift and say, now you're entering a musharaka with me, and the same thing happens again. Every contract can be arbitraged in order
Professor,
to lead to the same
5 minutes.
Thanks, sir. Right, so every contract can be used and arbitraged that way. As a matter of fact, there's a classical jurisprudence, huge debate about this. Some people have used some elements of that in order to justify that not all interest is the forbidden riba, and a lot of contemporary banking is not really violating the rules of riba, because you can think of the bank as the investor and the depositor, quote unquote, as Rabb al-Mal, as the investor, and they're investing on their behalf and specifying the profit as a percentage of the capital instead of as a percentage of the resulting profits is merely, at worst, an issue of gharar. And whether that's excessive or not depends on what's the legal environment that you have, what's your ability to do sufficient diversification and enough studies and have enough collateral and so on to limit the uncertainty that can lead to. And if you look back to the medieval period, there were lots and lots of debates about whether or not renting land for a fixed rent was allowed. It's the exact same argument. Because in Muzara'a, you share the crops according to some rules. But can you lease land? And of course, in the end, they allowed leasing lands, even though some people were claiming that there was a hadith that forbade leasing lands, Karra al-Ard. So all of these issues were rehashed in medieval time, and it was allowed when it was clear that that was the efficient thing to do. But somehow in banking, I think for ideological and political reasons, really, we've decided that there has to be an Islamic finance, it has to be different, but then they latched onto the wrong thing by saying it would be profit sharing. So is mutuality then the solution? So my argument is mutuality is not a panacea, because yes, mutuality solves some problems. If in a credit union, the shareholders are the same as the depositors, then you don't have two different stakeholders with a manager who has to manage this conflict of interest. They try to maximize the profits for the shareholders, but they do that by leveraging using the depositors' money. So it solves some moral hazard problems, but it doesn't solve them all. As a matter of fact, we have examples, for instance, from the savings and loans debacle where if you're holding assets to maturity, things like mortgages and so on, you could always use book value accounting instead of mark-to-market accounting and keep digging the shareholders deeper into a financial crisis. So it doesn't follow that some institutional form is going to solve all problems. As a matter of fact, if our objective is to replicate conventional finance, but we don't like the contracts, so let's go to the corporate forms, and we stick to forms, we fall into the same trap. The same problem we had with contract forms will hold for corporate forms.
2 minutes.
So I won't even need those. So my conclusion is all formula. So my view about Islamic finance actually is that it's symptomatic of a bigger problem with Muslim societies. That we want a quick fix, we want a formula, an algorithm, let me check these boxes and I will be a moral person, I'll be an honorable person. You can be a good Muslim banker in a regular bank. You can be an exploitative ribawi, murabi, in something that is labeled Islamic bank because you charge too much in the markup over your cost of funds. So it's ultimately not about forms. It has to be about substance. But all jurisprudence is about forms. We heard this morning, it's all about intention and so on. Intention is unobservable. I happen to be Shafi'i, so Imam Shafi'i, you never rule on intention. That's why issues like bay' al-'ayna and so on, as long as you document them as two separate contracts, he says the only way I can put these back together is to rule on intention, and I can't open somebody's chest and trust their intention. So my jurisprudence has to be based on what's observable to a judge. So jurisprudence is rule-based. Any solution that tries to, any attempt to find a solution by going to jurisprudence, by definition is going to be rules-based, is going to be obsessed with form, and will fall into the same trap, justifying the same injustices that were taking place, amplifying them through spurious trading parties and commodities and so on. So any type of Islamic finance in that vein is a mirage. It cannot be obtained. Now, can there be an Islamic finance? I don't know. Is it necessary for one to exist? I don't know. So necessity and possibility are both question marks, but what we have today certainly is bad finance that's not Islamic. Thank you.
Thank you very much. So that was our first speaker who spoke I think quite critically, but at the same time was also hopeful about mutuality in some form. And of course, he's the author of that very famous book published in 2006 on Islamic finance, but he's the author of many, many more. Our next speaker, our second speaker is Dr. Shariq Nisar, visiting fellow of Islamic Legal Studies program here at Harvard Law School. Please welcome Dr. Shariq.
Assalamu alaikum and very good afternoon to everyone. I'm going to touch upon the recent experience of demutualization and its possible impact and the experience that Takaful can learn to make further progress. We have observed that in 90s, there has been a growing trend of companies, especially mutual companies, becoming stock-owned companies. And there were a number of hypotheses raised in that favor. So what are the implications and what are those hypotheses? And what are the possible impact of those trends for Takaful? That is the theme today I'm going to talk about. My presentation is structured in this way. A little bit about mutuals and their core characteristics, and then followed by recent trend towards demutualization. I will have some examples of some of the topmost mutual companies becoming stock-owned companies through demutualization. What are the forms and drivers of demutualization in the process? Because each forms and drivers have some specific reasons. And then I will talk about, I will share some statistics about mutual insurance. What is the current status of mutual insurance? And then finally, what is the possible impact of demutualization over Takaful, or what Takaful can learn from demutualization, or what mutual can learn from the Takaful practices. So this is my presentation I will try to finish in 15 minutes, inshallah. As we all know, mutuals are democratic organizational format for conducting business activities. We find mutuals are very common in insurance sector. Mutuals are also common in stock exchange businesses, housing societies, as well as various kinds of cooperatives, credit societies. The core characteristics of mutuals are their customers are also the stakeholders. So there is no difference between customers and the owners or members or stakeholders. They are one and same. And the other very important feature of mutuals is that board of management is selected very democratically through one man, one vote, rather than one share, one vote. And that is the distinguishing feature of mutual as against stock-owned institutions. And the underlying feature of mutuality is, of course, solidarity and cooperation. Because members join together not to earn for profit and not to seek profit as much as they want to serve their own interest, which is often providing protection, providing cost benefit, so on and so forth. So another very important feature of mutuality is surplus. Whatever is surplus that is shared with the members, maybe in the form of dividend or in the form of rebate to the customers. And finally, the ascent is on rationalization of pricing rather than the seeking of profit. As against this, we have stock-owned companies where the interest of customers are subordinate to the interest of owners. Management control is based on the extent of investment. So somebody is having higher investment, obviously he will have higher stake and higher say in the management as against mutual. And then there is a clear distinction between management and ownership. Surplus, if any, belongs to stockholders or owners, shareholders, not the customers. And the primary objective of this is shareholders' benefit. So this is the difference between mutuals as well as stockholding. Coming back to demutualization and its trend, demutualization is nothing but converting a mutual institution into a stock-owned institution. And right from 90s onwards, we have seen increasing trend of big companies going for mutualization or demutualization. Till the period of 2007 crisis, 8-9 crisis, we see increasing trend. But after that, we see some sort of, the enthusiasm is not that much. The argument is also more balanced now. And also we see there is some debate on remutualization also happening after the crisis. Some people, especially in UK, there are discussions going on about remutualization. Still, some statistics I could collect from US, and that is shown in this table, where we see that conversion is still happening, although at a decreasing rate. In 2010, we had 24, and then 19 in 11. And then 2012, we had 13, and then this last year, we had 9 demutualization. So trend is still continue. There is no, of course, the speed is not that much as it used to be during 90s and early part of 2000, but it is still there. This is about the number, some major global demutualization year-wise, if you look at. This is just for example to show that it's not one of the aberration or something like that. It has been a very important trend over the years. Some of the important institutions getting demutualized. Similarly, in European countries also, we have this kind of institutions getting demutualized over the period. Coming to forms of demutualization. By and large, all this process happens through 3 forms. One is the traditional one, where surplus is distributed in the form of stocks, cash, or policy credit to the members, and the mutual institution is converted into a stock. There has been cases of litigations and other issues because every member's permission and other things was required, and therefore it was not very popular, but still traditional demutualization does happen. The second important type of demutualization is kind of the left side, that is subscription right. Here, the members' right is converted into subscription right of the new company. So if a company is getting demutualized, all the existing members will get subscription right in the new company, and then they will become shareholder, unlike a member in an old institution. Specifically in US case, mutual holding company has been popular way of demutualization for the reason that during 90s, I'm not sure about the year, there was some sort of tax rebate taken back from mutual institutions, and therefore it became tax inefficient for many mutual companies, and therefore, and there was an exception that if a mutual holding company is there, it will continue to enjoy the benefit of tax benefit. And because of this, the structure was something like existing mutual insurance company or mutual company will be converted into stocks, and the members of existing members' stake will be converted as a stake of a mutual holding company, and therefore this mutual holding company will continue to own the stake in the form of shareholding, and therefore it has certain benefits of in the form of tax advantages. It also had the benefit of avoiding hostile takeover. It also has had the benefit of litigation and other things, because mutuality concept and mutuality thing was still retained. So these are the three forms of demutualization which we experienced during the years gone by. There are various hypotheses for demutualization. Number of researchers have come across arguing for various kinds of arguments have been made, and one of the most important is organizational isomorphism, in which if in a similar kind of regulatory environment, if all the companies are trying to look for an efficiency or trying to look for efficiency, which is return on equity or something like a very defined parameter, then all the organizations will tend to achieve similar kind of path, and they will end up in a similar situation.
Dr. Shariq, so, 5 minutes.
Okay. So this is organizational isomorphism, where similar environment companies are trying to reach a same set of organizational structure, and that is leading to homogeneity of financial system. Of course, there are some other disadvantages. I will touch upon that a little later. Economic culture is also very important reason for demutualization argued. Recent era of liberalization, privatization, and globalization have led to a similar kind of economic culture environment across the globe, and that perhaps is also somewhere has been the reason of various institutions trying to achieve homogeneity. Wealth expropriation has been another very important hypothesis, where it has been argued that the mutuals management of the mutuals, they have been at the forefront in convincing the rest of the people or rest of their members in converting to demutualization, because it ended up increasing their revenue, their salaries, their perks in the form of cash, also cash benefit, as well as stocks. And it is actually self-interest of management which has been argued through expropriation hypothesis. Political environment is also, some of the countries have tried to disassociate themselves from elsewhile USSR era or socialism, and that has also been argued as one of the hypotheses for demutualization. Last but not the least, and rather very important, is inefficiency, because whatever I could understand from my study on this subject is, this is the most strong argument in favor of demutualization, because mutual institutions mutual, they tend to be little, uncaring or about their efficiency for the management and everything being same. So inefficiency has been one of the argument. Stock requirements bring efficiency for the reason that corporate culture and stock regulation requirement, they have certain parameters which brings better efficiency in a stock organization than a mutual one. Stock options also brings or attracts the best employees from the industry, and that is also one of the reasons that stock-owned institutions perform better than mutual-owned institutions. I'll try to move a little quickly rather. So the reason is here, demutualization provides greater access to capital, primarily through equity and also through debt, because if the equity base is high, then obviously ability to borrow is going to be higher. So that leads to higher capital base and higher solvency and etc. Other reason of demutualization is the fact that mutuals fail to minimize expenses, or because they are not tend to look for profitability, they are not so much concerned about maximizing revenue, and that brings kind of inefficiency, or that breeds inefficiency in the system. How the employees can perform best is through this incentivization of employees, and that is better in stock-owned institution rather than mutuals. Mutuals are unable to diversify also. They are unable to expand also because of lack of capital. Internally as well as externally, they cannot have expansion. They cannot have, their ability to expand is limited because of lack of capital. Having said all the researches that we have gone through, there is no conclusive argument in favor of demutualization. Still, there are trends which proves that this is not correct hypothesis. Especially if the access to capital is the most important reason, then what justifies many stock-owned institutions failing during the last crisis if they were able to achieve, get access to capital. So there was capital access hypothesis didn't prove much during the crisis. Another argument against demutualization is that mutuals are long-term, they are more suitable for long-term planning because they are not so much profit-seeking in the short run, and it helps them to look at the longer-term future rather than the shorter one, and that perhaps is the reason.
Dr. Shariq, can you start wrapping up now?
Yes. So that perhaps is the reason why Okay. Diversity and stability is the other reason, and presence of mutual leads to variety in the financial system. It brings more competition. It brings more stability because of various size, various types of institutions bring stability in the system. This is about the recent growth. If you look at mutuals over the years, this is very surprising that in the last 1 year, total premium in 2012 was 1.2 trillion USD, and it was employing about 1.1 million people. 1.1 million people and 800 million people were provided insurance through mutuals. Overall share has increased from 23% to 26%. This table gives gist. We can see that there is an increasing trend in favor of mutuals growing stronger over the year between 2007 and 2012. So this debunks the theory of demutualization actually. What is its impact on Takaful? Few of the points I will cover, and then I will finish it up. Conventional insurance, as we know that it involves trading of risk, but Takaful is based on injunctions of Sharia, and it is more close to mutuality or mutual cooperation. So that is one important reason that if demutualization is the trend, then obviously the future of Takaful is at stake, and we have to look at how Takaful can survive if that theory is true. Another very important point in this connection is Takaful structure is very close to mutuals, but not very exactly parallel. It is different. Actually, we can say that Takaful is a kind of hybrid mutual where Takaful underwriting is through Mutuality, but fund management is through stake-owned company or stock-owned company, which is managing the fund, which is managing the underwriting. So it is a hybrid kind of product, which is the plus point for Takaful, that mutuals can learn to survive. So I will just fill this.
Can you conclude now?
Yes, I'm almost done. I'm almost done. Because one important point I would like to highlight here is that underwriting side of mutuals type structure and ethical investment norms provide Islamic legitimacy, moral sanction, and potential resilience, particularly in case of re-Takaful. As we all know, that Takaful company cannot pass its losses to the customer. That's very difficult. But re-Takaful company can share its losses with the Takaful company, and that brings better Islamicity or more Sharia, better Sharia compliance for Takaful operation. Takaful operators' corporate structure can bring efficiency associated with the transparency and monitoring of a listed company. So the disadvantage of mutuality is addressed in Takaful as against the major argument for demutualization.
Shariq, time is up now.
Yes. This is my, okay. I think I have touched upon these important aspects, and during the discussion
people have read your papers, I think, so you can count on that.
Okay, thank you very much.
Ladies and gentlemen, a very interesting paper. As you'll see, he has some hopes that the mutual industry will be expanding, which is quite interesting because if we look back the last 100 years and ask how many companies that are still alive for 100 years in the insurance sector, what is their organizational type? The answer is majority are, in fact, mutuals and cooperatives. But now if you look to the future, we have one view, promising future. Another view, conventional view, is that the capital requirements, the regulatory requirements will be too high for mutuals. So very interesting. Let's see what our commentators have to say. Our first commentator is Professor Ibrahim Warde, who is the adjunct professor at the Fletcher School of Tufts here in, I believe, in Massachusetts itself. You have 5 to 7 minutes. 5 to 7. Yeah. I'll give you a warning at 5 minutes.
Okay.
So give it at 2 minutes, right?
Okay. Okay, hello everybody. It's always good to be back here. I think it's my 10th forum. So with the possible exception of Dr. Nazeem Ali, I may be the one who has been here the most frequently. And it was actually a pleasure to read both papers. They were both very interesting and very insightful. And I don't have anything very specific to say about Shariq's paper, but I know that since Dr. Mahmoud has been a bit controversial, to say the least, in the field of Islamic finance, I'm going to just make a few comments about his paper. And first of all, let me say that it's always a pleasure to read his papers from an academic standpoint, because there's a mix of erudition and controversy, which are really the two things that make any academic work very interesting. Now, I think the one dimension that I like to focus on in my own work, and where I differ from Mahmoud, is my focus on institutions and trying to explain how Islamic finance appeared in a broader context where religion and religious interpretation is one factor, but other factors such as politics, institution formation, etc., play a very important role. And in that sense, we can explain why we can probably not explain the emergence of Islamic finance in the 1970s if we don't look at the oil boom and its consequences on the region, or the end of the so-called Arab Cold War of that era. And based on that kind of a logic, there's again one expression that some of you may know, and that is very common in certain social sciences. It's the notion of path dependency, which essentially means that history matters, and the progression of events makes a difference. And therefore, when we're trying to change things, the change rather be incremental and based on what the previous events were about. And in that context, I think that Mahmoud's work is quite interesting. And one can wonder about if he had been 40 or 50 years older and had taken part in the recreation of modern Islamic finance, probably Islamic finance would have taken a different shape than what it did take. But given, and here I'm bringing up another dimension of this panel, which is the business model element. And here, if we look, in addition to the political aspect that I was talking about, if you look at the business aspect, meaning supply and demand, and here I think facts more or less speak for themselves in terms of the demand for the current form of Islamic finance. The fact that there has been rapid growth in the field of Islamic finance means that there is an interaction, again, between supply and demand. So it's in that context that, again, my question to Mahmoud would be the ways in which he thinks that his writings can actually make a difference and undo a lot of what has been done, and how this process can take place. Again, acknowledging that there's a lot of religious interpretation on the side of Mahmoud's analysis. And at the same time, I think that this whole notion of mutualization is a very important context, though not, as Mahmoud emphasizes, it's not a panacea. I don't think anything is a panacea. But then the question becomes, given the weight of institutions and the mood in general, if we go back, for example, to the phenomenon of globalization, the kind of ideology that accompanied the era of deregulation, in terms of, again, what in an earlier panel yesterday, I talked about the greed is good kind of logic. So if we factor in all of those environmental factors, then the question that would be interesting would be how concretely could an evolution towards a more mutually oriented system, how would that actually take place? So these are my brief comments. And again, I want to reiterate that I enjoyed reading both papers very much. Thank you.
Thank you very much, Professor Warde, for your comments and for your timeliness as well. The second commentator, ladies and gentlemen, is Ms. Farmi Dabai, who is a partner at Norton Rose and Norton Rose London, which of course does an enormous amount of work on Islamic finance. Ms. Dabai?
Thank you. Good afternoon, and Assalamu alaikum, everyone. I was fascinated by both of these papers because they both address personal interests of mine. I'm not a scholar. I'm a practitioner. So for the last sort of 10 or 12 years, I'm the person, one of the people that's responsible for drafting these documents, which generally start from a conventional perspective, and then we try and make them work from a Sharia perspective. And that's because of the world we operate in. We operate in a world where we're not just dealing with financiers and people who need to borrow the money. We're also working with rating agencies, with investors who have very generic investment criteria. And so one of my big worries is, for Islamic finance to truly work, do we need to create a perfect alternative world? Or do we need to try and accommodate the current world and make what we've got as good as it can be? I mean, I think I personally have a lot of sympathy with the views expressed by Professor El-Gamal. I think the issue that he's highlighted, which is Islamic finance all about form over substance? When I address gatherings like this, particularly of young people at universities, it's the issue that is always raised. There's usually an angry young man in the audience who puts his hand up and says, but it's all just rubbish, isn't it? You really are charging interest because you're calculating return by reference to LIBOR. And my response to that tends to be, well, it's not for me to decide. It's a question of what the investor wants. If they're comfortable with the structure, if a scholar has signed off on it that they respect and they are comfortable to enter into that deal, that's a matter for them. But that question of credibility is at the heart of Islamic finance. Because if you look at the growth levels of Islamic finance across the world at the moment, it's doing incredibly well. It seems to have passed, in my mind, a Rubicon, and it's on a trajectory of complete growth. And the only thing that's going to undermine that is if the people who are putting their first-time banking deposits into an Islamic bank feel that perhaps what they're investing in isn't truly Islamic. If there becomes a kernel of doubt there, then the industry as a whole will be at stake. And so the question that you raise is absolutely fundamental. I'm just not sure what the answer is, because we are trying to operate within a conventional world, and Islamic finance is still a very tiny part of that. And one of the things that I've sort of been interested in is looking at the Malaysian model, where when I've spoken to clients, they've said, we offer all of these full risk and reward participation products to customers, but they rarely want them. They want something that gives them a fixed return. They want something where their liability is limited. And so we have to offer products that customers want. And I think there are a number of things that I would urge scholars, you here, and academics to focus on. One is to look at the role of inflation. We never talk about inflation when we talk about whether what's being charged on a financing is riba or not. If I give you $100 today and you give me $100 back at the end of the year, have you treated me fairly? Because I can buy less at the end of the year than I can today. I think we have to find a way to address that. The other thing we have to address is people's attitude and appetite to risk. There are some companies that are willing to pay 3% or 5% in order to get financing to grow to the next stage, but they're not willing to dilute their equity for that. There has to be something between exploitative finance and something that dilutes equity when people don't want it. There's also a complete lack of equality. I am not in the same position to assess risk that a large financial institution is. So I'm not in the same position when I'm putting my salary into the bank at the end of each month as to whether I want to share fully with RBS on its latest venture. I don't know what they're doing, and they are in a better position, but I want my deposit protected. And it was very interesting in the UK when we first set up Islamic banks that the FSA insisted that the deposit protection scheme, which allows retail depositors to get, I think it's £85,000 back of a deposit from the state if the bank fails, they wanted that to be available to Islamic depositors. But the Islamic depositor would have the choice in the event of the bank's failure as to whether they would take that or not. And I think that's probably a fair compromise. It's up to each of us as individuals to make those decisions. But for me, the forms are rarely important. I think in your paper, Professor El-Gamal, you refer to the importance of justice being at the heart of Islamic finance. So for me personally, that's at the core of it. And so when we're looking at a contract, we should be looking at its fundamentals. Is this a fair contract? Do the parties understand that the bargain that they've entered into, is it exploitative? And if it is all of those things, or any of those things, then it's probably not a Sharia-compliant contract. Moving on to demutualization, which mutualization itself is a fascinating topic because, as you said, Dr. Shariq, it's a topic of huge interest in the UK, and especially in the run-up to the election next year, where the Labour Party is trying to come up with some financial ideas which are a little bit different from the consensus that's been in place for the last 30 years. But we've had some spectacular failures, as you've said. A lot of those building societies in particular that you referred to were demutualized for a combination of political ideology and greed, depositors in those building societies were going to get shares or cash when these building societies were demutualized. And people were going around speculatively opening accounts in building societies that they expected to be demutualized, and some people made some money out of it. But nearly all of them, as soon as they were demutualized, entered into riskier and riskier business, where they were using short-term financing for long-term funding, and most of them spectacularly failed. And yet, when there was a run on Northern Bank, when you looked at the depositors standing outside that bank waiting to get their money out, they were the most cautious people you could possibly imagine. You know, these were generally older people. They had carefully saved money all their lives. They hadn't realized that the institution that they had always invested in had fundamentally changed its nature. But for me, it wasn't the fact that the form was different now. It was sort of management oversight. It was an approach to risk. It was all of those things that had changed. So I don't think the failure of the mutualization model, certainly in the UK, means that it isn't an option for Takaful companies going forward, or that it's not an option for financial institutions going forward. I think it certainly is, but you just won't get the rates of growth that you would have done if you had massively over-leveraged yourself and gone in for proprietary trading in the way that many of them did. So I think mutualization is certainly an interesting topic. There's a really interesting paper that some of you might want to get hold of by the IMF on mutualization and Sharia finance and the sort of comparisons between the two. And I'm very familiar with the history of cooperatives and mutualizations in Europe over the sort of last 150 years, but I hadn't realized how entrenched that was in the US as well. There are a huge number of credit institutions, mutual financial institutions here. And generally speaking, they are a success, and I suspect that people will have increasing faith in them as people lose their faith in the conventional banks. So I see a very positive future for them. Thank you.
Thank you very much, Ms. Famida. There was a very interesting point there about connecting the points that Dr. Shariq made about the efficiency argument for demutualization. But the UK is an example where demutualization on the efficiency argument led to institutions like Northern Rock, which proved to be, if you like, the center of the disaster in the financial sector. So again, very interesting set of issues to address as we go forward into the question and answer session. Our third speaker is Khaled Al-Jasser. He's the Chief Executive Officer of Bank Al-Bilad from Riyadh in Saudi Arabia.
بسم الله الرحمن الرحيم الحمد لله رب العالمين والصلاة والسلام على أشرف الأنبياء والمرسلين سيدنا محمد وعلى آله وصحبه أجمعين ومن تبعهم بإحسان إلى يوم الدين. Distinguished guests, ladies and gentlemen, Assalamu alaikum wa rahmatullahi wa barakatuh. I would like to start with something just to be open, and that I am neither a scholar nor, as you have mentioned, a finance professor, but I am a practitioner, and I am a CEO of a bank that has been outgrowing the market in Saudi Arabia, and I'm very proud to be here presenting my comments in these two papers. But I would like to make sure that we are really aware of exactly how Islamic banking is going forward. I don't think we would have Moses' stick. We don't think we have quick fixes. But I think we should be very serious about looking at options of solving the conventional things that would like to be converted to Islamic and to be Islamic compliant and literally being Islamic based. For us in the bank, as we look at and even addressing these papers, is that we know that there are no quick fixes, as Dr. Al-Jamal have mentioned, but also I think we as the Islamic banking community, we should be looking at the research. We do have a lot of research in our bank, and I think this is what actually should lead to the development of a very and better Islamic banking solutions. Looking at the whether Dr. Jamal said there is a a conventional good guy or an Islamic bad guy. I don't think this is the story. I think we are doing our utmost and out best. And as a practitioner, when I look at the things that we do, if somebody who defaults in an Islamic bank is not being charged a single penny or a riyal for additional interest, this is what I call just. Because he has been given a loan for a certain period of time, it has to be paid in a certain time. If he defaults for any good or bad reason, we don't charge him more. So this is something that we are very proud of, and this is just. The other thing is that the ethical issues that we have as Islamic banks. Whenever we deal in anything, we look at the ethical issues. Are we applying our ethical issues? Are we honest? Are we sincere? Are we trying to give a helping hand? It's not only about money. If we wanted to be only on money, probably we'd have gone to gambling. But I think in an Islamic banking institutions, at least what I'm talking about myself and our small, modest institution, is that we look at these ethical issues probably more than the return on equity and return on assets. And that is